All right. Well, welcome back to the iWealth podcast. Today we're joined by Mr. Brad Connors, the owner of iWealth. And today we're talking a little bit about finishing up Q2, and it's bad now. It's bad out there.
Yeah, it's been a tough year, Matt. That's to say the least, right? And we're talking about markets. Obviously, hopefully, personally and professionally, you're doing okay. But it's been a tough market for sure.
What are you telling your clients right now as they're coming in to meet with you and you have to present them with the bad news?
Yeah, and so first of all, we've been pretty proactive.
Okay.
We've mailed out a lot of things, different videos, and just information about bear markets and things like that, which we'll touch on today. But for the most part, the glass has to be that full, half full instead of half empty. So we do have to have some silver linings in it. But I always tell my team that it's easy to look good when the markets are good, but this is when we get paid to do what we do. It's to sit knee to knee and have those conversations with our clients, those tough conversations about what's going on in the market. And so I'll just share a little bit of perspective. That what keeps coming in when you walk into iWealth on the wall is written up there. It says the 4 most dangerous words in investing is it's different this time.
Yeah, it's different this time.
Yeah,
I like that.
And Sir John Templeton said that years ago, and it just keeps reflecting back into my mind right now as I'm having conversations with clients. And it's absolutely true. This is not different. Here's what's different. If you were born after 1976, you haven't seen anything like this. Mm-hmm. But it's happened before. So this is the first time since 1976 that you've got bonds down double digits, your safe investments. You've got the stock market down 20%, which is a bear market. Yeah, at least, depending on where things are at. And then you also have, this new phenomenon called crypto. Crypto is down, 30, 40%, depending on what crypto you're looking at. And we don't, sell crypto or anything like that. But when you look at all three of those functions, mm-hmm. they're all down. And so you take a client that's got a 60-40 portfolio, 60% in stocks and 40% in bonds. This 40% in bonds is supposed to be kind of that safe haven that's down 10% temporarily on their statement. And it's ugly. And so, the first thing that I coach our advisors with is that, listen, the truth will set you free. You've got to lay it out there and let them know this is what's going on. People understand it's not us that are doing it.
Yeah.
But the perspective is this. We don't believe that if we go into recession, and that's an if, and it's probably next year if it happens, we don't believe it's going to be a hard recession. We think that this market has been oversold, so to speak. And the whole inflation thing that's coming up, and we're feeling it, right? You go to the gas pump, you feel it, and you go buy a grocery bag, you feel it.
Or in my case, you go up to Menards and you feel it.
Yeah. Although what has changed, so when you go to Menards now, lumber prices are starting to come down. Yeah. Copper prices are starting to come down. So you're starting to see the supply start to come up, the supply-demand thing. So that's happening. Last fall, I remember getting in an argument professionally with one of the money managers that we use because they basically said, Brad, so you think you're smarter than the Fed? Because I kept on saying, I just doesn't feel like when I meet with business owners that this whole inflation thing is transitory. That was the term that they used. And I didn't say I'm smarter than the Fed. It just didn't feel like it to me. Now I think the Fed has it right, though. I think the Fed was behind the 8 ball last year. They didn't do what they should have done. Now they're doing it, and I don't think you fight the Fed to use their speak. Okay. But I also believe that at the end of this year, that the Fed won't have to raise rates as fast as they think that they might have to. Yeah. And so you're starting to see that reflect in the bond market right now. You're starting to see companies like Target that are getting more supply, and there's going to be sales on lawn furniture and stuff that was been on a boat for 2 years and now finally showed up. So it's not different this time as a story to the client. Inflation is here. It's real, but it's not the 70s. We're going to be fine. Mm-hmm. And the best thing to own when things inflate are assets, real estate assets and stock assets or company assets, companies that can go up in value.
Yep.
You take a look at the S&P 500, which is 500 large company stocks down over 20% this year, depending on what day you take a look at it. Well, you've got Molson Coors, you've got Campbell's Soup, you've got Hershey's that are all up double digits this year.
Really?
So it's not like everything just goes down overnight, right? It just different companies at different times.
So when the stock market goes down, everyone goes out and buys Hershey's?
I guess they need a comfort food, and they're trading in their steak for Campbell's soup or something, and drinking beer.
Drinking beer. Stock market's down. Get a little beer.
Yeah. The average bear market lasts about 240 days.
Sure.
So we're in this bear territory, which is again 20% down in the market. 240 days is the average. Is it going to be average this time or more or less? We don't think it's going to be painful. So I guess, the main thing with our clients that we've been having a conversation with is just stay the course. Make sure that your money's diversified in different buckets.
Yep.
Meaning income bucket versus growth bucket. If you're in your 40s and you're growing your net worth, this is a great opportunity to be buying great companies on sale.
Maybe this is the buy right now. Yeah.
Where it really hurts is if you're retired and you're taking income to live on. You have to make sure that you have your money segregated in different buckets so that the money you're drawing out of today to write your paycheck, to put in your bank account, isn't down 20%.
Sure.
And for most people, that's not the case if they've set things up correctly. If not, they need to be talking to somebody about that. But we're having conversations about risk and returns and educating clients on this isn't different every 5 years or so, market cycles. And we just don't think that this inflation thing is here forever, and it's not going to be the 70s. And lastly, on this topic, what I would say, when you take a look at people's balance sheets, there's more money in people's bank accounts today. How they know this, I don't know, Matt.
Yeah.
There's more money in people's bank accounts today than pre-pandemic. So they still have cash. Now, their cash isn't going as far because the cost of goods are more expensive, but they have cash. And the same thing with businesses. Businesses are doing stock buybacks. They've got dividends that they've increased. They've noticed that things might slow down. They understand that. They're going to be smart about it. But real estate is another point. Interest rates have gone up. We went from 3% on a 30-year to 5.5, 6, depending on what day you look at it. But the housing market's still strong because we have an undersupply and we still have an overdemand. And back in the 80s, when your parents were buying houses or selling houses, interest rates were 13, 15%, and people still bought houses.
Yep.
So the world's not over. It's going to be fine. And if you don't feel fine, the best advice that I've got is talk to somebody. Get in front of a financial advisor, get in front of us, whatever, and have a conversation about your personal situation and how we can help.
Very cool. And all of this makes a huge difference for families that goes along with having that conversation. And from what you're saying, it sounds like that's what you enjoy doing.
Yeah. But it's a real thing. It's on paper. It's down. There's times in the market when it's best to maybe not look at your quarterly statement and wait for the next one. This might be one of those quarters. I can't tell you not to look at your statement, obviously, but it's ugly. It's the way it is. The way the market is. I said last before, but one more thing. Investing is not that hard. You have to have good people, smart people that are picking your investments, helping you with it. Mm-hmm. But your part is not that hard as long as you can bury your head in the sand once in a while.
There you go.
It's not different this time. It's true. And you can't be selling and making that paper loss become a real loss. And so that's where we're at with today's market.
Stay the course.
Exactly.
Very cool. Well, thank you so much for joining us, and we'll see you back here next time.
All right. Thanks, Matt.